why the traditional way is so much more normal, even though it's slower and riskier. I have a question for you. I could use your help with this one. And so I'm going to go ahead and pose this question. I need to lay some context for it first, but thank you for joining me today and spending some time with me. And I look forward to the feedback that I hear in this. I'm also going to talk about interest rates. Everybody always asks me where are interest rates going. Got the question again this morning. And so I'll talk about that for a minute. There's some cool, interesting things to be aware of with rates, but I think I'm gonna cycle, and I'm really excited. I'm actually gonna create a second video today that I'm gonna be sharing with my clients. I've been sharing the same thing with active clients for a couple of years now, but I'm gonna recut the video with any luck better. It's a look through history. It goes all the way back to the beginning of our country, interest rates. So feel free to look for that video. I don't know the name of it just yet, but it's gonna be something along the line of predict the future by looking at the past. It's been incredibly insightful information, and I used to share it a lot with all my clients until the mortgage process got so much more complicated, and now I don't have time, and so I just created a video and share it that way. Anyway, back to the question. So I'm going to talk to anybody that's been listening to me for any length of time knows that I talk about mortgage planning a lot. What's mortgage planning? Mortgage planning is the set of principles. It's a nickname that we give a set of principles that cycle around mortgages that, when understood, people usually go about paying off a mortgage in a completely different way than traditional. So mortgage planning principles, for example, understanding your true interest rate. If you look at your mortgage and you have tax savings as a result of the mortgage interest, and you are typically allowed that, what is the actual interest rate? Because if you see, you need to subtract the tax savings to actually recognize what the true cost is. Another one is, when should you be paying extra at the mortgage? There's just a bunch of little things to consider. And so I have been talking about this stuff forever. My question that I have for you, that I need my help or the help with, is I can document that it's a faster, safer way to pay off a house this way, these ways, following these principles, this pattern. And I can do that, but every time I go online, all I see are videos showing the alternative. And the alternative, I'm going to call it the traditional way. The traditional way is kind of a conglomeration of several different things. So we'll start with a 15-year mortgage. I think everybody understands 15-year mortgage. It's 15 years instead of 30, which means it has a much bigger monthly payment, but it often has a smaller interest rate. And so the idea is that you pay your house off 15 years versus 30. Huge opportunity for savings. Everybody understands that. If you take a 30-year mortgage and make a 15-year payment, the whole time, you're going to pay the house off pretty dang close to 15 years. It might be 15 and 3/4 or 16 years, but it's going to be dang close to that 15 years. The only difference, of course, is that you're going to be paying a little bit more interest because you have a slightly higher interest rate because you took a 30-year mortgage, but you still get paid super fast. And that's obviously exciting. A lot of people dream about that day. But I argue that that's still a long time from now. 15 years is still a very long time from now. And so the safety of burying all your money into the house, that's part of one of my arguments. Okay, well, a 15-year mortgage is one of the ways to pay it off, one of the traditional ways, I'll call it. Another way that people pay mortgages off early is biweekly payments. Now, what a biweekly payment means is that you divide your monthly payment due into every other week payments. And when you do that, you end up making 26 payments a year instead of the 24. Because if it's 12 months in a year and you divide it into two, you're paying 24, but you end up paying 26 if you do biweekly, which means you pay an extra monthly payment every year. And sometimes, in some situations, you're able to actually apply that principal payment a little earlier and reducing the interest paid. That also is going to get you paid off a little bit earlier. And any amount of extra principal payment at any time is going to get you paid off earlier. Those are all still under the same umbrella of traditional payoffs. And then there's one really complex one out there. It's actually not a horrible idea. It's just really complex, and I think a lot of people have a hard time wrapping their mind around it. Some people call it velocity banking, and what it is you get a home equity line of credit and you use it like a checking account, right? So you get your direct deposit from your job and have it direct deposited into this HELOC, home equity line of credit. And that means you have to have a balance because every time you get a check, you're making a payment. So anyway, people would use that, and it's kind of a reverse of a checking because you owe money in your HELOC, and every time you get paid, it pays down the balance. And then when you pay your bills, it expands the balance. But doing that cheats the daily interest, thereby allowing you to save some interest, thereby allowing you to pay off your mortgage faster. And that's the idea, is that you take the extra money and pay it into your mortgage. As complex and interesting as that idea is, it's still just a traditional prepayment of your mortgage. So here's the question is, why are those so prevalent, those ideas so prevalent? When I go online, that's all I see, tons and tons of those videos. I don't see videos talking about this alternative. And the alternative, I can sum it up, I call it mortgage planning. I didn't name it that, that's what it was called when I heard about it 23 years ago. But what mortgage planning is and does, it can be summed up with this. Never pay anything extra in your mortgage ever, but invest anything you would ever pay. Invest it instead, obviously wisely and carefully. I'm not saying go throw it in the cryptocurrency market, but if you invest it carefully, kind of like you would your 401 or something like that, then the theory behind that is that you will have more money in that account faster because it's compounding, typically at a higher interest rate than your own mortgage. And then one day you can take and liquidate that account to pay off the mortgage in full. And side by side with the traditional payoff, you'll actually get there faster because it's been compounding interest, so you have a bigger balance faster than you would have if you paid it directly into the mortgage. And then on top of that is that money is your money the whole entire time. You don't have to call me up and ask for a sale or a refinance. If you need that money for some family emergency, you can access that money. And so it's a safer path, it's a faster path. So I just don't understand. And so my question to you is why? Why I guess why don't we see more videos talking about what I'm talking about? We all know that I'm not a wonderful presenter. Wish that I was. I wish I was more interesting online because this message is a great message for people to understand. But I don't hear anybody else talking about it online. And I've seen it too much in my own life and in the lives of my clients to know there's any kind of fault to it. There's rules that we need to follow, right? Like, again, what are you going to invest in? That's a key component. But I think it's more valuable for people to spend time learning mortgage planning and then execute it in their lives, and I'm here to help them do it. So why is it so much less popular even though it's at least 23 years old? And to be honest, or to be clear, I have clients just like me that have followed the program and they've gotten the results just like we expected. Better, faster, and safer ways to pay off our home, safer arrival dates. And I've been doing this 23 years, which means I know quite a few people who have paid off their homes because they did it this way, faster, safer. So anyway, help me out, would you? Either weigh in, comment, tell me why it is the old way is more, or the traditional way is so much more common. Is this one of those cases where wide is the gate, or what is it? Wide is the gate that, I don't know how, there's some scripture that talks about straight is the path and narrow is the way, but wide is the gate that leads to hell and misery, or I don't know, something like that. Is it one of those? That the common way is just the wrong way and the masses are going down that road? Why don't we hear anybody else talking about this stuff? This is the secret banks don't want you to know. This is the secret that'll really empower you financially. Okay, I'm going to turn corners. I'm going to go ahead and talk about interest rates. It seems like everybody always wants to know about those, so I'm going to give you guys an update on where rates are at. And then I'm going to actually end the video, and I'm going to go ahead and start, go make that second video. So look for that, how to predict the future from the past. But for right now, let me go ahead and share my screen and we'll share the interest rates with you as soon as I can figure out what screen. There we go. So as you can see, today's rate, 5.625 FHA, 6.25 conventional. Now, if you look at the national average today, it's 0.75, believe it or not. 0.75 conventional, that's the national average rate for conventional loans. And believe it or not, that has a cost to it, the national average cost does. But 6.25 or 6.75, that's about where our no points conventional rate is. So the 6.25 you see on my screen, this does have some fees on it, hence why you see the 6.7 APR right below. Also this 5.6, same exact story. FHA's rate's probably a little over 6% right now with no fees on it. So if you want to, I think the 5.6 makes more sense for a lot of people. It has some fees on it though, hence the bigger APR. Now with FHA, they have a big mortgage insurance premium, so their APR is always much bigger than the difference in conventional. So anyway, that's it for where interest rates are. Now, why are rates where they are? So Iran is 99.9% of the answer to that question, and I don't think it's really all that interesting to talk about at the moment. I think everybody's pretty aware of what's happening in Iran. The quick summary is that the whole Iran thing began, shut down Strait of Hormuz, which shut down a lot of oil flow and supply. Therefore, the price of oil shot through the roof, and all of our gas prices went way up. Of course, inflation goes up. Inflation is the arch enemy to mortgage bonds, and so when inflation goes up, then mortgage rates have to go up to compensate, because again, it's a 30-year investment. They need to make their money, and they're afraid that they're going to lose it. So interest rates go up to compensate for inflation. We thought the conflict was coming to an end, and so rates started showing signs of improvement, and then the fight started all over again. And it's just been more back and forth of that for months, as you know. When that's over, then we'll start to see a pathway for where rates are going to go. Okay, but until that's over, or at least the news is not important to anyone anymore. Afghanistan lasted for what, 20 years or something like that? It was no longer newsworthy, frankly. It just became part of the normal. I wouldn't say that because, of course, lives were lost and stuff. That's serious stuff. I'm just talking about mortgage rates, interest rates and stuff. And so if Iran ever reaches that point where nobody's reporting on it anymore, kind of like the Ukraine war, then you'll see interest rates start to make their own new path. In the meantime, it's being impacted. Also very interesting, two other things. So foreclosures and the Federal Reserve. foreclosures, guys, this is where it's really important that we learn how to read fake news. It's not fake. There's foreclosure headlines out there. Foreclosures are up 25% or 37% or whatever. Guys, foreclosures have been so low. I talked about this a few weeks ago. They've been so low for so long that if you increase it, even one more foreclosure a month and it doubles, right? It's a 50% increase or whatever in foreclosure activity. Guys, during the pandemic, there were no foreclosures. Like there was a moratorium on foreclosure. And there haven't been a whole lot of foreclosure since. I say that, and I'm talking statistically. We got millions of homeowners across the country. And so a few 100,000 foreclosures or something is going to be very, very small on the perspective scale. Anyway, we're nowhere near, we're not even a shadow of 2007 or 8. Okay, so be careful what you read. Just recognize and learn how to read through a filter. Feel free to ask me questions if you ever want some of the insider scoop. Jump on one of these and comment, and I'll comment back. Or others that have opinions that are valid might also comment. So the Federal Reserve. So the Federal Reserve has had a significant influence on interest rates. They are the reason that rates went down during the pandemic. They are the reason rates went up in 2022. And so it's important to know what they're doing. But you also need to remember everything I'm telling you. Remember this: the Federal Reserve does not set mortgage interest rates. They set the Fed funds rate. The Fed funds rate is similar to what banks lend to each other overnight. And so annually is not an important rate in that situation. But banks balance with each other overnight, every single night. Too many deposits, too many withdrawals, and they need to balance out. And so they lend to each other overnight. That's what they do, and/or to the Federal Reserve. And that's what the rate is that they set. But it has a big impact on all the rest of the rate world. And so the Federal Reserve, though, is changing. They're changing in a major way, something we haven't seen in probably decades. But Kevin Warsh, the new Fed president, albeit overshadowed by Jerome Powell still, Kevin Warsh is of a very, very different opinion than the current Fed or the previous Fed president, several. He does think the Federal Reserve is too transparent. He thinks they're too much in the media. And there's a bunch of Fed presidents and speakers that are constantly still in the media, and that's against his ideals. He's seeking to quiet that down. Tomorrow is, well, at the time of the recording of this video tomorrow, whenever you watch it, could be a different time. But the Federal Reserve is going to make another announcement, and when they do that, they have always, for a long, long time, have had a press conference after they meet. But that's going to maybe start to change. That most likely we'll have a press conference tomorrow, but this may be one of the few, actually. There's a lot of information Kevin Warsh is asking for, and so he's got 5 different task forces that he's assigned. It's very likely that we won't hear a whole lot of anything as the months go by until the end of the year. So keep that in mind. He's going to basically try to put the Federal Reserve back in the shadows, a little bit less in the center, front and center. Not everybody and their dog should know who the Federal Reserve is or what it is. And yet that's kind of where they're at right now, and all the Fed speakers seem to love it. He feels differently. So heads up to that. How that matters, I don't know. He seems like he's a really good Fed president, though. He seems like he knows what he's talking about and will be a really valuable Fed president. So we're happy with what he's doing, but it's going to be pretty significant changes. So we shall see. Other than that, I think that's about it for this. I do have just a quick little prompt here. If you're interested in more information on the mortgage planning, I do have 3 short videos that I've put together as a playlist. So check out our playlist and feel free to watch and comment on those or whatever, because yeah, this is good stuff. Mortgage planning is crazy powerful. I have done it myself. We paid off our house significantly sooner than we should have because I followed the principles that I didn't lay out. It wasn't because I made extra money or anything else. I invested the money and the investments worked, just like we teach. So anyway, let me know if you got any questions or comments. Please give me some comments and or information and ideas on why the traditional way is so much more normal, even though it's slower and riskier. All right, have a great day. We'll talk to you later.